Welcome to the Stock Market Palantir. Today, we are going to talk about NBIS, Nebius Group NV, it's easily one of the most compelling and complex equity stories in the AI infrastructure space right now. This is a company that has completed a truly historic corporate metamorphosis, successfully shedding its previous geopolitical baggage and emerging as a pure-play provider of critical AI compute. The market reaction has been, well, nothing short of explosive. We saw a staggering 390% rally in 2025, followed just recently by a really sharp correction, driven by all the fear surrounding that DeepSeek R1 efficiency catalyst.
And it's vital to understand that the chaos in the stock isn't just, it's not just driven by macro news or contract wins. The underlying market structure here is profoundly abnormal. For context, we have to note this extreme market anomaly. The off-exchange short volume ratio is sitting around 62.75%. That figure alone, which reflects how much trading is happening away from public exchanges, it severely complicates any simple read on the price action and introduces some pretty significant technical fragility.
That extreme volatility really sets up our central tension. I'm going to argue that Nebius is fundamentally de-risked and, frankly, structurally undervalued. Its massive strategic megadeals and its proprietary neocloud tech advantage create a real structural moat, a guaranteed path to major returns that I just don't think the market has digested yet.
And I'm coming at it from a different angle. While those multi-billion-dollar contracts are certainly impressive, they are, at the end of the day, commitments of scale. The underlying financial reality, the massive capital intensity needed for growth, the financing risk that comes with it, and this existential threat of AI efficiency deflation, it makes NBIS an unstable, speculative bet. The risk profile is just far too high to call this a stable utility provider.
Right. So the bullish case is really rooted in this structural validation. Nebius executed what I'd call a textbook corporate divorce. By divesting the legacy Russian assets, the company completely liberated itself from that geopolitical discount that had crushed its valuation for years. It didn't just walk away clean, it emerged with a pristine balance sheet, approximately $2.5 billion in cash and zero debt. For a high-growth infrastructure play, that is an incredible starting point. And this clean slate was immediately validated by the absolute highest echelon of customers. We are talking about securing an unprecedented $17.4 billion capacity agreement with Microsoft, then followed quickly by a $3 billion deal with Meta Platforms. These are utility-grade contracts. They transform Nebius from a speculative company into an indispensable provider of GPU infrastructure for the two biggest drivers of AI. And, the confusion that spooked some investors about a crisis or a reverse split, it's just misplaced. The reduced share count came from a large share buyback after the divestment, which is, as you know, generally a highly bullish signal.
That financial clean slate is critical. I get that. But what about the demands those new contracts put on it? You mentioned $2.5 billion in cash, but management has guided for a staggering $5 billion in capital expenditure just for 2025. This introduces immediate, unavoidable financial risk. That $2.5 billion shortfall, well, it necessitates external financing, either highly dilutive equity offerings or significant debt. Investors are betting on favorable capital markets continuing just for them to meet those demands. And this financing issue is compounded by technological risk. Let's talk about the DeepSeek R1 event. That model release showed that frontier-class capabilities could potentially be achieved using only $6 million in compute. This challenges the entire premise of the exponential scaling laws that justify these multi-billion-dollar valuations. Why would you commit to a $17 billion contract if the job can be done for a fraction of the cost sooner than expected? And finally, we have to understand how the market is trading this uncertainty. That extreme dark pool activity, over 60% of trading volume off-exchange, it signifies very complex institutional maneuvering. This lack of clear price discovery on the lit market creates a kind of illiquidity trap, making the stock highly prone to sudden, violent, air pocket price swings that are completely divorced from the underlying cash flows.
I see why you emphasize those risks, especially the capital intensity. But the confidence to deploy $5 billion in CapEx is rooted in two factors. the technological moat, and the guaranteed demand that's validated by those contracts. I mean, NBIS retained over 1,000 top-tier engineers from the original division. This is not a standard data center REIT. This is a highly sophisticated engineering house building its own competitive advantage. They build their own proprietary software stack, which lets them bypass the so-called virtualization tax, that extra layer of software that competitor clouds pay for. Plus, they design custom hardware that achieves the higher power density needed for next-gen GPUs, like NVIDIA's Blackwell series. This technical differentiation guarantees demand. And we know this because the meta deal size was capped only by NBIS's available capacity. That isn't a company begging for business. That's a company in a seller's market, which gives them crucial pricing power.
Stack does provide an initial edge, but proprietary tech doesn't grant you immunity from the law of diminishing returns on compute spend. How specifically does proprietary software shield you from the fundamental deflation risk that DeepSeek demonstrated?
The prevailing market narrative reacted by repricing the entire sector based on this fear that the traditional AI scaling thesis was broken. You're relying on the Jevons paradox, the idea that cheaper compute leads to more demand, offsetting the efficiency gains. That might hold true eventually, sure, but we're talking about training compute, which drives these massive deals. If hyperscalers like Microsoft realize they can get their results with far less capacity, they will slow down leasing third-party infrastructure when those 5-year contracts eventually roll off. The financial leverage you're taking on now could turn into painful oversupply later. That's a fundamentally strong argument about long-term deflation. But I will frame the risk profile differently. The DeepSeek fear is, for now, speculative about its macro impact. The revenue visibility, on the other hand, is contractual and concrete. The $17.4 billion Microsoft agreement provides a 5-year cash flow floor, averaging about $3.5 billion annually. This massive contracted backlog substantially de-risks the CapEx thesis. NBIS isn't relying on speculative future demand to pay for their build-out. They have signed high-grade contracts. Based on these agreements, we have high confidence in revenues potentially surpassing $4 billion a year by 2027. This contract is essentially a long-term revenue mortgage, guaranteed by Microsoft. That allows NBIS to get far more favorable debt to finance the build-out than a typical startup ever could, which mitigates your dilution concerns significantly. The CapEx is required to service demand that already exists.
I see the financial logic there, using guaranteed revenue as collateral. But that brings us right back to the market structure, which is currently pricing in maximum volatility. The stock price has been wildly erratic, and the reason is embedded in the flow. The high off-exchange volume, coupled with, about a 12% short interest, means NBIS is heavily influenced by two major forces. One, that highly volatile retail sentiment, the poor man's NVIDIA crowd. And two, complex institutional hedging flows, what traders call a gamma battle. This toxic mix of retail speculation and institutional hedging means the stock acts as a lightning rod for broader market fear. How can you square the stability implied by a $17 billion contract with a stock that trades like an early-stage biopharma company, prone to these sudden, dramatic reversals, completely detached from any fundamental news?
I'm not convinced that institutional hedging or retail fervor are the main drivers over the long term. I think we need to be precise here. The high off-exchange volume is often just a necessary component for institutional block trade execution. When major funds are accumulating multi-million-dollar positions, they have to do it off-exchange to avoid tipping off the market and driving up their own costs. A 62% ratio could simply mean that sophisticated funds, maybe sensing the deep undervaluation, are quietly accumulating large, long positions. If so, the structural setup is actually bullish. And also, let's not overlook the built-in mitigants. The company successfully completed its difficult corporate pivot, solidifying its position. But more importantly, the retained non-cloud assets are critical, overlooked call options on future value that reduce the risk you're describing.
I'm talking about Avride, their autonomous driving unit, which already has a partnership with Uber, and Toloka, their human-in-the-loop data labeling platform.
These are high-quality, diversified businesses that reduced the reliance on a single AI supercycle narrative.
I fully acknowledge the value of those retained assets. They offer high-quality diversification, and if they were spun out, they'd fetch a significant valuation. However, we have to be intellectually honest here. The stock price today is 90% sensitive to the AI infrastructure narrative. While those high-grade contracts with Microsoft and Meta are fantastic, the inescapable financial reality is the need to raise $2.5 billion or more to meet the CapEx guidance in the next, 12 to 18 months. This means investors are taking a leveraged bet on flawless execution and on the continued favorability of debt and equity markets. The risk profile is significantly higher than a company that can organically fund its own growth, and that high level of external dependence is exactly why the volatility is so extreme. You're betting on the company flawlessly executing a massive build-out while simultaneously navigating a hyper-volatile market and managing this looming threat of technological deflation. It's a lot to ask.
So, to summarize my position, NBIS is a rare phoenix in the capital markets. It survived a near-fatal geopolitical event and emerged with a laser focus that has been fundamentally validated by the most sophisticated AI players on the planet. The contracts with Microsoft and Meta provide a significant multi-year floor of cash flow, de-risking the aggressive CapEx. This structural positioning means the company is deeply undervalued compared to its peers. I mean, look at CoreWeave, a private competitor valued in the tens of billions without the public liquidity or the same kind of contractual backlog. The demand is proven. The stock is just waiting for the market structure to catch up.
And I maintain that while the contracts are undeniably robust, the stock remains a structural battlefield. The sensitivity to technological shifts, like the DeepSeek efficiency gains, demonstrates how quickly the investment narrative can change. When you combine that with the massive capital expenditure requirement and the extreme market microstructure, well, the potential rewards come with significant and unpredictable volatility. Investors need to enter this trade with deep forensic analysis, recognizing they are buying into a high-leverage business model that must execute perfectly on its financing.
Ultimately, the question for listeners is whether you trust the fundamental strength and guaranteed cash flow from multi-billion-dollar contracted demand, or if you are deterred by the technical risk implied by a complex market structure and high capital intensity.
Exactly. It's the conflict between signed revenue today and the looming execution-dependent financing requirement tomorrow.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.